This video provides a weekly market recap for the week ending July 10, 2026. We cover the latest on the Iran ultimatum, the Federal Reserve's task force, and current market conditions. Please note this is not financial advice. In this mission brief, we explore the U.S. deadline given to Iran regarding the Strait of Hormuz. We also look at the Federal Reserve's new task force and current technical market signals. We operate by mapping every claim to specific levels on your chart. Here is the board in 60 seconds. The Iran ultimatum means potential combat operations this weekend. Warsh's task force aims for cheap debt without quantitative easing. Technically, the S&P is pinned, while semiconductors and crude oil show significant signals. Act 1 of our analysis focuses on the board. We will review Friday's close, the overall weekly picture, and identify the one index currently signaling a warning. Friday closed with the S&P and NASDAQ in the green, while the Russell 2000 lagged behind. This narrow leadership is a typical sign of a market running out of momentum, despite some major indices showing gains. Friday's performance highlights a clear divergence. Large caps rose while small caps fell. This narrowing risk appetite is a classic late-cycle indicator. We are watching to see if this weakness spreads to larger companies next week. The S&P 500 is currently testing overhead gap levels. Friday's high puts us just 5 points below the first resistance. We are tracking two primary scenarios: a break below the June peak or a potential triangle formation. The NASDAQ 100 is trading sideways with mixed signals. It has filled one gap, but significant resistance remains above. The June 9th low serves as a key level. Closing below this could trigger a broader crash scenario. Small caps are acting as the canary in the coal mine by failing to join the large cap rally. Their heavy reliance on floating rate debt leaves them vulnerable, and their weakness suggests that current market strength may be deceptive. Crude oil is coiling, with a critical test near $67. We are preparing for two possible paths, but both point to an oil shock that the current market has not yet priced in. In Act 2, we address the 0 hour. We examine the specific Saturday ultimatum delivered to Iran and the implications for potential combat operations in the region. The U.S. has issued a firm deadline. Iran must publicly renounce its actions or face consequences. While this forces a decision, the likelihood of Iran complying is low, given their past behavior and strategic reliance on regional instability. There are three core demands on the table: acknowledging the waterway is open, stopping attacks on commercial vessels, and ensuring all shipping lanes remain accessible without tolls or forced routing. When asked about the potential consequences of silence, a U.S. official indicated a difficult outcome is ahead. This implies that if Saturday passes without renouncement, combat operations could resume as early as this weekend. This ceasefire scorecard shows that Iran has made zero concessions and violated multiple agreements in just 3 weeks. Our analysis continues to track these developments as they unfold. Let's look at the quota trick. Iran promised open access, but instead enforced a 15-ship-per-day quota through fire and harassment. This confirms their goal remains controlling the strait to hold the global economy hostage. The deadline is critical because it forces an end to these word games. This week saw over 170 precision strikes on Iranian targets. These were not merely symbolic messages. They were logistics kills, designed to disable Iran's ability to sustain their campaign, including severing smuggling routes from Russia and China. Key infrastructure hits include a major railway bridge, a vital smuggling artery, and a critical targeting tower used to coordinate vessel strikes. By destroying these, we are directly degrading Iran's capacity to continue their harassment campaign. Next on the target list, the power grid and remaining bridges. We are also looking at re-establishing the blockade and targeting Kharg Island. Taking the island would effectively shut down 90% of Iran's oil income overnight. Kharg Island is the regime's single point of failure. By neutralizing this asset, we don't just punish the regime, we defund it. A regime without funds for its enforcers is one that cannot sustain control, moving us closer to internal collapse. We are also watching the Kurdish wildcard. Reports indicate they are preparing to launch their own offensive against the regime. This internal challenge, combined with external pressure, could be the spark that proves the regime is vulnerable. Our regime collapse pathway follows 5 steps: degrade logistics, strangle oil income, darken the power grid, spark internal resistance, and finally, watch the system collapse. The focus remains on attrition, not occupation. Looking at the countdown for July, the deadline is this Saturday. Weekend strikes could lead directly to full combat operations. By mid-July and August, we expect to see a full-fledged combat base case unfold. With under 4 months until the midterm elections, the White House is in a difficult position. Striking now risks an oil price spike right before the vote, but waiting makes them look weak. Expect high volatility during this period. The market has incorrectly priced in a durable ceasefire and diplomatic settlement. With combat operations and a critical oil choke point now a reality, the current crude bottoming pattern suggests we should prepare for an oil spike. History suggests a sequence. Stocks peak, recession begins, gold peaks, and crude peaks last. We are comparing current data to the 2007-2008 cycle, which suggests we are in a high-risk window for a commodity-driven market event. Act 3 covers the tape. We are analyzing gap maps, wave counts, and the critical silver blueprint that the semiconductor sector is currently mirroring. For the S&P 500, we have two primary counts. Count A suggests a bearish wave 2, while Count B suggests a final pop to run the stops before a major reversal. We are watching key levels for a decisive move. We are mapping the magnets overhead. The 7,620 level is the referendum line. If the S&P runs to fill the gaps at 7,584 and 7,610, while the NASDAQ refuses to confirm, that divergence will be our strongest signal of a turning point. Finally, Friday's hanging man candle is a potential warning sign. However, it requires confirmation through a downward close and sustained selling. Until then, we treat it with caution rather than conviction. Let's look at the NASDAQ 100 on the 60-minute chart. We are tracking two open gaps near 30,347 and 30,264. Friday's close at 29,825 puts us in a chop zone, but the lower gaps are filled. A move below the June 9th low would be our primary trigger for a crash scenario. For the NASDAQ 100, we're weighing a bull case triangle against a bear case trapdoor. The bull case needs semiconductors to hit a new high. The bear case relies on a close below the June 9th low, which would confirm a lower high and lower low, signaling a violent wave 3 down. We are watching the divergence between the S&P 500 and the NASDAQ. The S&P peaked June 2nd, while the NASDAQ peaked June 3rd. This one-day divergence is a classic signature of a market top, mirroring historical patterns where one index makes a final new high while the other refuses. Consider the silver blueprint. It moved from a grind to a parabola, then printed a reversal bar, followed by a 54% collapse. The semiconductor sector has just completed its own reversal bar. If this follows the silver script, we are entering the fourth and final stage. Semiconductors are signaling trouble. Since their highs, they've dropped 16% in 3 weeks. Friday's bounce pushed them into broken moving averages. If they track the silver collapse, we could see a return to the April 2025 lows as the broader tech sector faces significant pressure. When we overlay the semiconductor chart with silver's historical blow-off, the anatomy of the top is identical. Semis led the tops in 2021 and 2022, and if current levels break, they will likely lead the way down again. The crash is a process, not a single event. Semiconductors determine everything. They led the bull market, and they have been the first to crack at every major top. The current trade is crowded with positioning and expectations at extremes. No new high in semis means the bull case for tech effectively ends here. We track the divergence stack to manage risk. The RSI and short-term oscillators are already signaling a bearish turn, while other indicators like the MACD are waiting for final confirmation. We are armed for the breakdown, watching for the moment all signals align. The big picture is a rising wedge spanning 6 years. We've seen a failed overthrow of the trend line, and price is now back underneath. Whether we see a final, exhausting run to new highs or an immediate rejection, the destination remains the same, a significant downward correction. Examining midterm history, specifically 2018 and 2022, reveals a clear pattern. Markets tend to sell off into the election vote, with the worst damage occurring after the results are in. We are applying this historical rhyme to our base case for 2026. Our crash roadmap has 4 stages. First, the breach of key support. Second, the primary wave 3 decline. Third, the false hope of a counter-trend rally. And fourth, the final drop toward our target levels. The first leg is historically the most violent. The most dangerous sentiment on Wall Street right now is the belief that a major market crash is impossible. Complacency is the fuel for the initial move downward. History proves that when the market is this convinced of its own invincibility, the reversal is usually swift. In Act 4, we look at the road to zero. Kevin Warsh's new Fed brain trust is laser-focused on cheap debt. All the pieces point to a strategic shift that favor low rates, but the path to get there is fraught with volatility. Warsh's playbook is built on buying time using task forces and silence. This creates a stealth dovish environment that is bullish in the short term. However, the risk is that if a crisis hits, there will be no quantitative easing cavalry to bail out the market. Our 2032 thesis remains: interest rates drifting towards zero, the end of aggressive quantitative easing, and a shrinking Fed balance sheet. We expect to navigate the inflation pulse from recent events before settling into a long-term period of debt-driven structural adjustment. This video examines the machinery behind a major regime change. Our focus is on the roster of experts, 15 voices shaping a vision of credible data and disciplined policy, moving away from aggressive rate hikes toward a future of low rates and no money printing. First, we look at Nobel laureate Thomas Sargent. His doctrine argues that inflation is controlled by regime credibility, not rate hikes. He maintains a hard stance against monetizing debt, serving as the intellectual backbone for this strategy. Next is Greg Mankiw, who has long advocated for negative interest rates as a stimulus tool. He aligns with our core thesis, supporting cheap debt for those with conviction, while firmly opposing arbitrary money printing. William White, the former BIS economist, brings an anti-quantitative easing perspective. His approach emphasizes creative destruction, arguing that we should allow bad businesses to fail rather than offering bailouts that breed instability. Raghuram Rajan, former governor of the RBI, focuses on the dangers of excessive risk-taking fueled by easy money. He advocates for a slow reduction of the balance sheet to maintain market stability. Jeremy Stein, a former Fed board member, acts as our market plumber. He supports keeping the balance sheet short and focused on short-term bills, rejecting long bond buying, which he believes artificially distorts stock market valuations. Karen Dinan, former Treasury chief economist, emphasizes operational efficiency. Her focus is on running the Fed with discipline, avoiding vanity projects to signal stability and build public trust. Mervyn King, former Bank of England governor, offers a unique perspective as a former pioneer of QE who now criticizes its addiction. His voice adds significant weight to the call for ending these practices. Peter Fisher, formerly of the NY Fed Open Market Desk, brings insider experience regarding Treasury operations. He is a vocal critic of forward guidance, arguing against the promises of printing that distort market expectations. The former president of the Central Bank of Brazil, representing, quote, the Brazil play, shows how credibility is built from the ground up during a crisis. He proves that policy success relies on earning belief through results. Raj Chetty brings the data engine. His real-time tracking of private payroll and spending allows policymakers to react to economic turns weeks before official data, preventing the mistake of late-cycle rate hikes. Doug McMillan provides the real-world perspective of a retail leader. By monitoring shelf-level prices, he acts as a witness to deflationary pressures, providing a crucial check on macroeconomic assumptions. Kevin Murphy, the measurement skeptic, questions the accuracy of official inflation gauges. He argues that if CPI overstates inflation, current policy is effectively tighter than it appears, creating room for rate cuts. Mark Andreessen, the abundance evangelist, focuses on the structural deflationary impact of technology and AI. While he favors cheap money to support innovation, he is a primary voice for easing, as deflation takes hold. Finally, Charles Jones provides the mathematical counterweight. He notes that if AI drives major productivity growth, the neutral rate could rise. Ultimately, this group remains tethered to real-time data to guide their decisions. We now transition to the role of Asha Sharma, who brings her experience from Microsoft AI and Meta to the team. Her perspective marks a shift where AI is treated as a core policy input, reinforcing the view that technology-driven deflation is now a permanent structural assumption. Looking at the voting pattern within this group, a clear consensus emerges. The overwhelming majority of members are firmly against the money printer. While they debate the pacing of policy, the direction is set. Cheap debt is acceptable, but arbitrary monetary expansion is strictly off the table. We must navigate two distinct clocks. In the short term, through December, we expect no rate hikes as silence acts as stealth accommodation. Looking long-term toward 2032, the expectation is a slow bleed of rates towards zero, with the critical caveat that the next crash will not be met with a money printer. The survival instruction for the next 5 years is clear. Get your legs out of the pot of debt. In this cycle, debt will not be your shield. Leverage holders face the risk of being left without a rescue, making the reduction of credit lines essential for long-term survival. This brings us to the playbook. We are operating in a market with a Saturday deadline and a jury already in session. Our task is to analyze these scenarios and price levels required to navigate the weeks ahead effectively. The scenario matrix helps us visualize potential paths. Whether we see a pop and drop recovery, a reject and break correction, a sideways grind, or a weekend shock triggered by external events, we must remain flexible and ready to pivot as the macro environment evolves. Target levels for Monday are critical. We are watching the SPX at 7,620 for a potential pop, alongside the open gaps at 7,584. Defensive positions are anchored by the 50-day moving average, which serves as a vital line for market stability. Our watch order prioritizes 5 key items: the outcome of Saturday's events, the price of crude oil, semiconductor leadership, SPX gap fills, and the NDX June 9th low. That final level, the June 9th low, acts as the primary threshold for flipping our broader market outlook. In synthesis, our analysis rests on 3 pillars: macro developments regarding the Saturday ultimatum, fundamental exhaustion in semiconductor leadership, and technical indicators showing a stack of divergences across all timeframes. We are prepared for either path the market chooses. To stay aligned with this strategy, follow our updates on Substack, X, and our other channels. Our commitment remains firm. We are bound by rules, and we maintain the discipline required to navigate these markets. This content is for informational purposes and does not constitute financial advice.